The world believes oil is fading. Markets price it as yesterday's problem. Policymakers speak as if energy no longer sets the limits of growth. And yet, every time oil tightens, inflation explodes, debt cracks, and stability disappears. This is not a story about running out of oil. It is a story about running out of margin. The most dangerous energy crisis is not the one you see on price charts. It is the one embedded inside the global economy itself, hidden, structural, and already unfolding. Oil is not a sector of the global economy. It is the physical layer beneath it. Long before finance became abstract, digital, and detached from material limits, oil defined the speed, scale, and reach of economic growth. Every modern economy, regardless of ideology or level of development, is built on the assumption that energy will be dense, portable, reliable, and cheap. Oil satisfied all four conditions better than any resource in human history, and the entire architecture of globalization was designed around that fact. The industrial acceleration of the 20th century was not primarily a story of technology or capital. It was a story of energy surplus. Oil condensed millions of years of stored sunlight into a liquid that could be extracted, transported, refined, and consumed with extraordinary efficiency. This surplus allowed economies to grow faster than populations, productivity to rise faster than wages, and consumption to expand without immediately exposing its true costs. When economists speak about growth, they usually describe capital accumulation, labor efficiency, or innovation. But none of those variables operate independently of energy. Without abundant oil, capital becomes expensive, labor becomes less productive, and innovation slows to incremental improvements rather than structural leaps. Every modern supply chain is an oil chain in disguise. Food production depends on petroleum-based fertilizers, diesel-powered machinery, and global logistics networks that move calories across continents. Manufacturing relies on petrochemicals for plastics, solvents, insulation, and synthetic materials that have no scalable alternatives. Transportation systems, from container shipping to aviation, are optimized around liquid fuels with high energy density. Even digital infrastructure, often portrayed as weightless and clean, is grounded in oil-intensive construction, maintenance, and energy backup systems. The internet does not float in the cloud. It rests on concrete, steel, rare materials, and uninterrupted power, all of which are inseparable from fossil energy. The critical insight that markets rarely price correctly is that oil is not consumed at the margin. It is embedded systemically. When oil prices rise, the impact is not confined to fuel costs. It propagates through input prices, logistics, food, housing, and services. Inflation triggered by energy is structurally different from inflation caused by demand overheating. It cannot be solved by interest rate adjustments alone because it originates in physical constraints rather than financial excess. Central banks can suppress credit, but they cannot drill wells, refine barrels, or transport energy more efficiently in the short term. Historical data shows a persistent relationship between periods of sustained economic expansion and stable or declining real energy costs. When oil was cheap and predictable, businesses invested in long-term projects, infrastructure expanded, and globalization deepened. When oil became volatile or structurally expensive, growth slowed, inequality widened, and political instability increased. This pattern repeated across multiple decades and regions, regardless of monetary regimes or fiscal policies. Energy abundance created optionality. Energy scarcity exposed fragility. In the post-war period, oil exporting nations accumulated geopolitical leverage not because of ideology or military strength alone, but because they controlled the marginal supply of the most critical input into global production. Institutions such as OPEC did not merely influence prices. They influenced inflation trajectories, balance of payments, and the stability of entire economic models. Import-dependent economies built their prosperity on the assumption that oil markets would remain liquid and politically manageable. That assumption shaped everything from urban design to trade policy. As globalization intensified, oil quietly became the hidden subsidy behind efficiency. Offshoring production made sense because transportation costs were low relative to labor arbitrage. Just-in-time manufacturing worked because fuel was reliable and inventory could be minimized. Financialization expanded because physical constraints appeared distant and manageable. But this efficiency was conditional. It depended on a narrow energy foundation that was never truly diversified. The system did not eliminate risk, it concentrated it. In recent years, the narrative surrounding oil has shifted dramatically. Public discourse increasingly frames oil as a declining asset, a legacy fuel being phased out by innovation and environmental necessity. Yet empirical consumption patterns tell a different story. Global oil demand has remained resilient, rebounding quickly after shocks and continuing to underpin industrial output, trade volumes, and military logistics. The world economy behaves as if oil remains indispensable, even as policymakers speak as if it does not. This contradiction is not accidental. It reflects a deeper tension between physical reality and financial abstraction. Markets can price expectations, but they cannot repeal thermodynamics. Substituting oil requires not only alternative energy sources, but alternative materials, infrastructures, and behaviors at scale. That transformation is slow, capital intensive, and politically constrained. Until it occurs, oil remains the invisible backbone of economic activity. From an investor's perspective, this creates a structural blind spot. Traditional valuation models often treat energy as an input cost rather than a systemic variable. Growth forecasts assume stable access to energy without explicitly modeling its constraints. Risk assessments focus on financial leverage while underestimating energy leverage. This mispricing leads to cycles of overconfidence followed by abrupt repricing when energy conditions tighten. The global economy did not evolve beyond oil. It evolved around it. Every attempt to analyze growth, inflation, or stability without placing energy at the center produces incomplete conclusions. Oil is not the story that markets like to tell, but it is the story that explains why economies expand, stall, or fracture. Until that reality is fully integrated into economic thinking, policy responses will remain reactive, and investors will continue to be surprised by crises that were structurally inevitable. This is the foundation. Everything that follows, from inflation dynamics to geopolitical conflict, builds on this single fact. Modern economic complexity is an expression of energy surplus. Remove the surplus, or make it volatile, and the system does not gradually adjust. It destabilizes. The era of cheap energy did not end with a single event. It dissolved slowly, unevenly, and then all at once. For decades, the global economy operated under an assumption so deeply embedded that it was rarely questioned. Energy would always be available at a price low enough to be ignored in strategic planning. Oil was treated as an input, not a constraint. That assumption shaped corporate balance sheets, government budgets, trade flows, and household expectations. When it began to break, the system did not adapt smoothly. It reacted defensively, often misdiagnosing the cause of its own stress. The turning point was not a shortage of oil in physical terms, but a shift in the cost structure of extraction. Easy oil, defined as large conventional fields with high energy return and low marginal cost, peaked earlier than most official forecasts admitted. As mature fields declined, production growth increasingly depended on more complex sources: deep water, unconventional reservoirs, politically unstable regions, and capital-intensive technologies. Each new barrel required more investment, more energy input, and more time. The industry could still deliver volume, but not at the same price or with the same reliability. This change coincided with a financial environment that rewarded short-term returns over long-term capacity. Energy companies were pressured by shareholders to prioritize dividends, buybacks, and balance sheet discipline, rather than aggressive reinvestment. Governments, influenced by climate narratives and fiscal constraints, reduced support for long-cycle fossil projects without providing scalable substitutes. The result was a structural underinvestment in supply that did not immediately show up in prices, but accumulated silently as latent risk. Oil markets are often described as cyclical, but that description hides a more important reality. Cycles are shaped by investment decisions made years earlier. When prices are low, capital exits the sector. When prices rise, new supply cannot respond quickly because development timelines are long. This lag creates volatility that monetary policy cannot smooth. Interest rates can influence demand at the margin, but they do not accelerate drilling, infrastructure, or geopolitical stability. Energy inflation therefore behaves differently from other price shocks. It persists, reappears, and compounds. The economic consequences of this shift became visible through repeated inflationary episodes that did not respond predictably to tightening financial conditions. Energy costs fed directly into transportation, food production, housing materials, and industrial inputs. Wage pressures followed, not because of overheating demand, but because households were compensating for higher living costs. Central banks responded with higher rates, suppressing investment and credit growth, while the original driver remained untouched. This policy mismatch amplified economic fragility instead of restoring balance. Geopolitics further tightened the system. Energy trade, once framed as mutually beneficial interdependence, reverted to strategic leverage. Exporting countries reassessed their role, not as price takers, but as custodians of scarcity. Coordinated supply management by groups such as OPEC was no longer aimed solely at stabilizing markets, but at preserving long-term revenue and political influence in a world signaling eventual demand decline. This incentive structure discouraged overproduction and reinforced price floors that importers had not budgeted for. At the same time, demand proved far more resilient than projected. Emerging economies continued to urbanize, industrialize, and expand transportation networks. Aviation recovered. Petrochemical demand grew with packaging, pharmaceuticals, and industrial materials. Even sectors marketed as part of the energy transition relied heavily on fossil inputs during construction and scaling phases. As a result, global oil consumption repeatedly surprised on the upside, clashing with narratives of imminent decline. Financial markets struggled to reconcile these signals. Energy equities were undervalued relative to cash flows, reflecting skepticism about long-term viability rather than near-term necessity. Bond markets mispriced inflation persistence by assuming energy shocks would be temporary. Policymakers oscillated between denying structural change and reacting to its consequences. This created an environment of chronic uncertainty where volatility became normalized, yet poorly understood. The end of cheap energy did not announce itself as a clean break. It emerged as a pattern of instability. Price spikes followed by political intervention, demand destruction followed by recovery, underinvestment followed by shortage. Each cycle left the system slightly weaker, slightly more leveraged, and slightly less flexible. What had once been a tail risk became a core variable. This is not merely an energy story, it is a macroeconomic one. Cheap energy functioned as an invisible productivity multiplier, masking inefficiencies and enabling growth models that depended on scale rather than resilience. As that multiplier faded, underlying weaknesses surfaced. Debt burdens became heavier. Supply chains became brittle. Policy tools lost precision. The economy did not slow because of poor management alone. It slowed because its energetic foundation became more expensive and less predictable. This structural shift defines the current era. Growth is constrained not by capital availability, but by input costs that cannot be financialized away. Inflation is driven not only by demand, but by physical limits. And volatility is not an anomaly, but a signal. The age of cheap energy is over, not because oil disappeared, but because the conditions that once made it effortless no longer exist. The system continues to operate, but it does so under tension, consuming buffers that will not easily be rebuilt. This is only the first half of the picture. The deeper consequences unfold as economies attempt to manage this transition without acknowledging its true nature. The second half of this transformation is where the economic damage compounds. Once cheap energy disappears, the system does not simply recalibrate prices. It begins to change behavior, incentives, and risk tolerance across every layer of the economy. What initially looks like an energy problem evolves into a productivity problem, then into a debt problem, and finally into a political problem. This sequence is not theoretical. It is observable across multiple regions simultaneously. As energy costs rise structurally, businesses lose their primary shock absorber. In a cheap energy environment, inefficiency can be hidden. Logistics mistakes are survivable. Excess inventory is manageable. Long supply chains make sense. When energy becomes expensive and volatile, these margins vanish. Companies respond by cutting investment, shortening planning horizons, and prioritizing liquidity over expansion. This defensive posture suppresses long-term growth even when demand exists. Capital is preserved, not deployed. The impact on productivity is subtle but severe. Productivity growth depends on energy leverage. Machines amplifying human labor, transportation expanding markets, automation reducing unit costs. When energy inputs become more expensive, the return on productivity enhancing investment declines. Firms delay upgrades. Infrastructure ages. Output per worker stagnates. Official statistics often lag this reality, but the effect is cumulative. Over time, economies appear to grow, but the quality of growth deteriorates. More effort produces less surplus. At the macro level, governments attempt to bridge this gap through fiscal expansion. Subsidies, transfers, and stimulus programs are used to offset rising costs and maintain social stability. However, these measures do not create energy, they redistribute financial claims. When funded through borrowing, they increase debt without expanding productive capacity. The result is a feedback loop. Higher energy costs weaken growth, weaker growth increases reliance on debt, and higher debt makes the economy more sensitive to inflation and interest rates. This is where the monetary framework begins to fracture. Central banks are trained to respond to demand-driven inflation. They raise rates to cool consumption and credit. But energy-driven inflation does not originate in excess demand. It originates in constrained supply. Raising rates suppresses investment and housing, but it does not lower fuel costs, fertilizer prices, or shipping expenses in the short term. Instead, it compresses real incomes while leaving cost pressures intact. This creates stagflationary conditions that traditional models struggle to address. Global trade amplifies the problem. Energy-intensive goods become more expensive to move across borders. Countries that once benefited from globalization face higher import costs and weaker export competitiveness. Trade balances shift, currencies adjust, inflation becomes uneven, creating tension between trading partners. Energy exporters gain leverage, while importers absorb volatility. The idea of a neutral, rules-based global market weakens as states prioritize energy security over efficiency. Geopolitical alignment increasingly reflects this reality. Energy policy becomes national security policy. Strategic reserves are rebuilt. Long-term supply agreements replace spot market dependence. Export controls and sanctions are weaponized. These moves reduce market flexibility and reinforce price rigidity. Coordination among producers, including actors within OPEC, is no longer about smoothing cycles, but about managing decline and preserving fiscal stability in producer states. Supply restraint becomes rational behavior, not market distortion. Meanwhile, the promise of substitution remains largely aspirational. Alternative energy sources scale slowly and require massive upfront investment, itself dependent on fossil inputs. Electrification increases demand for materials whose extraction and processing are energy intensive. Storage limitations constrain reliability. Grid upgrades lag behind policy ambition. None of this negates the transition, but it delays its economic payoff. During this interim period, the system carries the cost of both old and new energy structures simultaneously, increasing overall burden. Financial markets react inconsistently. Equity valuations oscillate between optimism about innovation and fear of margin compression. Energy assets trade at discounts, reflecting long-term uncertainty, even as their near-term cash flows remain critical. Fixed income markets struggle to price persistent inflation risk. Volatility becomes structural rather than episodic. Risk premiums rise not because of panic, but because predictability erodes. For households, the consequences are tangible. Energy costs permeate everyday life through transportation, heating, food, and goods. Even when headline inflation moderates, living costs remain elevated relative to wages. This erodes trust in institutions and fuels political polarization. Policy responses become reactive, often contradictory, and increasingly constrained by fiscal realities. The social contract strains under pressures it was not designed to absorb. From an investor's perspective, this environment demands a different framework. Growth assumptions based on historical energy conditions are no longer valid. Correlations shift. Assets once considered defensive become exposed. Strategies built on liquidity abundance face diminishing returns as physical constraints reassert themselves. Understanding energy is no longer a sectoral concern. It is a prerequisite for macro analysis. The end of cheap energy is therefore not a temporary phase. It is a regime change. It redefines the boundaries within which economies operate. It limits the effectiveness of policy tools. It reshapes global power structures. Most importantly, it forces a reckoning with the fact that economic systems are not self-contained financial constructs. They are physical systems, governed by inputs that cannot be printed, postponed, or wished away. This sets the stage for the next illusion, the belief that the energy transition will painlessly resolve these tensions. That belief collides with reality in ways that are only beginning to emerge. The belief in a smooth and inevitable energy transition has become one of the most powerful narratives in modern economics. It reassures policymakers, comforts investors, and offers a moral framework for societies under pressure. According to this story, fossil fuels are being steadily replaced by cleaner alternatives. Efficiency gains will offset rising costs, and growth will continue with a different energy mix. Oil, in this view, is no longer central. It is a declining input, gradually losing relevance as technology advances. The problem is not that this vision is false in principle. The problem is that it is false in timing, scale, and economic mechanics. Energy transitions in history were not substitutions, they were additions. Coal did not replace wood overnight. Oil did not eliminate coal. Natural gas did not erase oil. Each new source expanded total energy availability rather than displacing the old one. Growth accelerated because energy supply increased in absolute terms. The current transition is fundamentally different. It attempts to replace a dense, flexible energy source with systems that are intermittent, material intensive, and dependent on the very fossil fuels they are meant to supplant. This is not a neutral swap, it is a structural tension. Public discourse focuses on end-use consumption, particularly electricity and transportation. Electric vehicles, solar panels, wind turbines, and battery storage dominate headlines. What remains underexplored is the upstream reality. Building renewable infrastructure requires vast amounts of steel, concrete, copper, rare earths, and processed minerals. Mining, refining, transporting, and assembling these materials are energy-intensive activities. At present, that energy comes overwhelmingly from fossil fuels. The transition, therefore, increases fossil energy demand during its build-out phase, even as it promises future reductions. This creates a paradox that financial models rarely capture. Capital is diverted from traditional energy supply toward transition projects, reducing investment in oil and gas capacity. At the same time, fossil energy demand remains resilient, supported by industrial activity, global trade, and the construction of new energy systems themselves. The result is a tightening supply environment precisely when reliability matters most. Prices rise not because of sudden shortages, but because spare capacity disappears. Volatility becomes structural. Electrification is often presented as a solution to this dilemma. Electricity, however, is not an energy source. It is a carrier. Its reliability depends on generation, storage, and grid stability. Renewable generation is variable by nature. Solar output fluctuates daily and seasonally. Wind is location-dependent and unpredictable over short horizons. Storage technologies remain costly, resource-constrained, and insufficient for large-scale, long-duration balancing. Grid upgrades lag demand growth, constrained by permitting, financing, and political opposition. These are not engineering challenges alone. They are economic bottlenecks. Transportation illustrates the gap between narrative and reality. Passenger vehicles can be electrified under certain conditions, but heavy transport, aviation, shipping, and military logistics have no scalable alternatives to liquid fuels in the near term. Even within road transport, electrification shifts energy demand upstream, increasing pressure on power systems that were not designed for such loads. Meanwhile, petrochemicals remain irreplaceable for plastics, medical supplies, fertilizers, and industrial processes. These uses do not disappear with electrification. They expand with population and income growth. Global statistics reflect this contradiction. Despite record investments in renewable capacity, total primary energy consumption continues to rise, and fossil fuels retain a dominant share. Oil demand rebounds quickly after disruptions, signaling deep structural dependence. Energy intensity per unit of output declines gradually, but not fast enough to offset absolute growth. The transition reduces emissions at the margin in some regions, while increasing them elsewhere through material production and supply chain shifts. The net effect is complexity, not clarity. Policy frameworks exacerbate these dynamics. Subsidies and mandates accelerate deployment without resolving integration challenges. Carbon pricing raises costs but does not guarantee substitution. Regulatory uncertainty discourages long-term investment in both fossil and non-fossil systems. Energy producers face conflicting signals: produce less to meet climate goals, but ensure affordability and security to avoid social backlash. This tension leads to cautious behavior, underinvestment, and a preference for short-cycle projects over durable capacity. Geopolitics further complicates the transition. Control over critical minerals becomes as important as control over oil once was. Supply chains concentrate in a small number of countries, introducing new dependencies and vulnerabilities. Export restrictions, trade disputes, and strategic stockpiling distort markets. Energy security returns to the center of national strategy, undermining assumptions of frictionless global cooperation. In this environment, coordination among traditional producers, including those aligned through OPEC, takes on renewed significance, not as a relic of the past, but as a stabilizing force in a fragmented system. From a macroeconomic perspective, the transition imposes overlapping cost structures. Economies must maintain existing energy systems while financing new ones. Consumers pay for reliability, redundancy, and experimentation simultaneously. Inflationary pressure emerges not from excess demand, but from layered inefficiencies. Fiscal budgets strain under subsidies and infrastructure spending. Monetary policy tightens in response to price instability, raising the cost of capital for exactly the investments the transition requires. This feedback loop slows progress and heightens risk. Financial markets oscillate between optimism and disappointment. Each technological breakthrough fuels expectations of rapid change. Each bottleneck triggers repricing. Long-term narratives collide with short-term constraints. Valuations reflect hope rather than cash flow resilience. Meanwhile, legacy energy assets, though essential, are treated as transitional and therefore undervalued. This misalignment creates cycles of scarcity and surplus that propagate volatility across asset classes. The illusion of a seamless transition persists because it postpones difficult trade-offs. It allows societies to believe that growth, stability, and decarbonization can advance simultaneously without sacrifice. But energy systems do not respond to belief. They respond to physics, capital allocation, and time. The current transition is real, but it is not smooth, cheap, or fast. It unfolds within an economy still anchored to oil, constrained by materials, and sensitive to disruption. This is only the first layer of the illusion. The deeper consequences emerge when these structural frictions collide with debt, demographics, and political limits, transforming an energy challenge into a systemic one. The deeper illusion emerges when the transition narrative collides with balance sheets. Energy systems do not exist in isolation. They are financed, leveraged, insured, and politically mediated. Once the cost and complexity of transition projects are translated into financial terms, the gap between ambition and feasibility becomes impossible to ignore. What looks like technological progress at the surface often functions as a macroeconomic drag beneath it. The capital requirements alone redefine risk. Large-scale renewable deployment, grid modernization, storage infrastructure, and mineral supply chains demand upfront investment on a scale comparable to post-war reconstruction. These projects generate returns over long horizons, often dependent on regulatory support rather than market pricing. In a world of higher interest rates and constrained fiscal space, this creates a fundamental mismatch. The cost of capital rises precisely when capital intensity increases. Projects that appeared viable under near-zero rates struggle to clear hurdle thresholds once financing costs normalize. This shift alters investor behavior. Pension funds, insurers, and sovereign investors seek duration and stability, yet energy transition assets often deliver neither in early stages. Cash flows are uncertain. Policy frameworks change with electoral cycles. Technological obsolescence risk remains high. As a result, private capital becomes selective, demanding guarantees, subsidies, or risk transfer mechanisms. Governments step in to fill the gap, increasing public debt and contingent liabilities. The transition becomes fiscally embedded. Debt dynamics amplify the strain. Advanced economies enter this period with historically elevated debt-to-output ratios, accumulated during years of cheap money and crisis management. Emerging markets face external financing constraints and currency exposure. Funding energy transformation through borrowing assumes future growth will service today's liabilities. But growth itself is constrained by higher energy costs and reduced efficiency. This circularity weakens long-term sustainability. Inflation interacts with this process in destabilizing ways. Transition-related spending raises demand for materials, labor, and logistics. Supply bottlenecks push prices higher. Central banks respond by tightening monetary conditions to protect price stability. Higher rates increase debt servicing costs and depress investment appetite. Governments face a trade-off between supporting the transition and maintaining financial credibility. Neither option is neutral. Both impose costs. Labor markets reveal another friction. The transition promises job creation, but the distribution is uneven. Skills mismatches slow redeployment. Regions dependent on legacy energy industries resist change. New jobs often require different competencies, concentrated in different locations. Adjustment costs are real and persistent. Wage pressures rise in specialized sectors while broader productivity gains lag. This contributes to inequality and social tension, complicating political consensus. At the international level, divergence intensifies. Wealthier economies can subsidize, absorb volatility, and experiment. Poorer economies prioritize affordability and reliability. Energy transition pathways fragment along income lines. Carbon leakage increases as production shifts to regions with lower costs and weaker regulation. Global emissions outcomes improve less than projected, while geopolitical friction grows. Cooperation gives way to competition for resources, technology, and strategic advantage. The illusion also distorts corporate strategy. Firms align rhetoric with policy incentives, but operational realities force compromises. Dual systems persist. Fossil inputs remain embedded. Reporting frameworks emphasize targets rather than resilience. This divergence between narrative and execution erodes trust over time. Markets begin to discount long-term promises and focus on near-term survivability. What emerges is not a clean transition curve, but a prolonged overlap of systems under stress. Old energy is constrained by policy and capital. New energy is constrained by scale and integration. The economy carries both costs simultaneously. This dual burden suppresses growth, increases volatility, and reduces policy flexibility. It is not collapse, but chronic strain. From a strategic perspective, this is the critical insight. The transition is not failing because it is unnecessary. It is struggling because it is being forced onto an economic structure still dependent on oil, debt, and globalized supply chains. Ignoring this reality leads to repeated surprises. Inflation that does not fade, shortages that appear despite capacity, and political backlash against policies framed as inevitable. The illusion persists because acknowledging these limits requires redefining expectations. It implies slower growth, harder trade-offs, and delayed payoffs. It challenges the assumption that markets and technology alone can reconcile physical constraints with financial promises. Until that reckoning occurs, the energy transition will remain not a solution to instability, but a contributor to it. This sets the stage for the next phase of the story, where energy, inflation, and debt converge into a single systemic pressure point that no policy tool can isolate or fully control. Inflation in the modern economy is often discussed as a monetary phenomenon, a consequence of excessive demand, loose policy, or mismanaged expectations. This framework worked reasonably well in a world where energy was cheap, abundant, and stable. In that environment, prices moved primarily in response to financial conditions. Today, that logic is incomplete. Energy has reasserted itself as the dominant transmission mechanism through which inflation spreads, persists, and resists control. Oil sits at the center of this process, not as a headline price, but as a multiplier embedded in every cost structure. Energy-driven inflation behaves differently from classic demand inflation because it originates upstream. When oil prices rise, they do not simply affect consumers at the pump. They alter the cost base of production, transportation, storage, and distribution simultaneously. A rise in fuel costs increases freight rates. Higher freight rates raise input prices for manufacturers. Manufacturers pass costs to wholesalers, who pass them to retailers, who pass them to households. By the time inflation appears in consumer indices, it is already propagated through multiple layers of the economy. Monetary tightening at that stage addresses symptoms, not causes. This distinction matters because policy tools are asymmetric. Central banks can reduce demand by raising interest rates. They cannot increase energy supply, lower extraction costs, or stabilize geopolitics. When inflation is driven by energy constraints, higher rates suppress investment precisely when new capacity is most needed. This creates a paradoxical outcome. Policy designed to restore stability instead deepens structural imbalance. Growth slows, but prices remain elevated relative to incomes. Historical patterns illustrate this clearly. Periods of sustained inflation have often coincided with energy shocks rather than credit booms. Oil price volatility introduces a cost-push dynamic that monetary policy cannot neutralize without collateral damage. Each tightening cycle aimed at containing inflation increases debt servicing burdens across public and private sectors. As rates rise, governments face higher interest expenses, households face mortgage stress, and corporations delay capital expenditure. The economy becomes more fragile even as inflation proves stubborn. Debt transforms this fragility into systemic risk. Over decades of cheap energy and low rates, global debt expanded faster than productive capacity. This expansion was sustainable only under conditions of stable input costs and predictable growth. Once energy costs rise structurally, The margin for error narrows. Higher inflation erodes real incomes. Higher rates increase nominal obligations. Together, they compress fiscal and financial space. The system becomes sensitive not just to shocks, but to volatility itself. Governments respond by attempting to shield households and strategic sectors from energy price swings. Subsidies, price caps, tax relief, and strategic reserve releases become common. These measures reduce immediate pain, but transfer costs to public balance sheets. They do not eliminate inflationary pressure, they redistribute it over time. When financed through borrowing, they add to debt stock. When financed through taxation, they reduce disposable income and investment. Either way, they constrain future policy options. The interaction between energy inflation and debt creates a feedback loop that is difficult to escape. Rising energy costs weaken growth. Weaker growth worsens debt ratios. Higher debt increases sensitivity to interest rates. Higher rates suppress investment and slow supply response. Slower supply response keeps energy prices elevated. The loop tightens gradually, not explosively, which makes it harder to identify and harder to interrupt. At the global level, this dynamic produces divergence. Energy exporters experience revenue windfalls that support fiscal stability even as they manage domestic inflation. Import-dependent economies face deteriorating trade balances, currency pressure, and higher domestic prices. Exchange rate adjustments partially absorb shocks, but introduce new inflation channels through import costs. Monetary policy synchronization breaks down as countries face different inflation drivers and fiscal constraints. The idea of a uniform global cycle fades. Geopolitical factors amplify these pressures. Energy supply is increasingly shaped by strategic considerations rather than purely economic ones. Production decisions reflect long-term revenue optimization, fiscal break-evens, and political leverage. Coordination among producers, including those operating within OPEC, reinforces supply discipline in an environment of declining investment and uncertain demand trajectories. This coordination does not aim to create scarcity artificially, but to manage volatility and protect fiscal stability in producer states. From the perspective of importers, the effect is the same: higher and more rigid price floors. Financial markets struggle to price this regime. Inflation expectations oscillate between complacency and alarm. Bond yields reflect both fear of persistence and belief in eventual normalization. Equity valuations compress as margins face pressure from input costs and financing conditions. Asset correlations shift. Traditional hedges underperform. Risk management frameworks built for demand-driven cycles misfire in a supply-constrained world. The labor market becomes another transmission channel. As energy costs raise living expenses, workers demand higher wages to preserve purchasing power. Employers, facing higher input and financing costs, resist. Negotiations intensify. Wage gains lag inflation in aggregate, but pockets of scarcity drive localized pressure. This uneven adjustment fuels dissatisfaction and erodes trust. Productivity growth, already constrained by energy costs, cannot offset wage demands without further price increases. A wage-price-energy loop emerges, slower than classic spirals, but more persistent. The political consequences are predictable. Inflation driven by necessities rather than discretionary spending generates stronger backlash. Voters tolerate higher prices for luxury goods. They react sharply to higher food, fuel, and housing costs. Policy credibility erodes when promised relief fails to materialize. Populist pressures rise. Energy policy becomes a battleground between affordability, security, and environmental goals. Compromises satisfy no one fully. From an investor standpoint, this environment requires reframing inflation risk. It is no longer sufficient to monitor demand indicators or central bank guidance. Energy fundamentals, investment trends, and geopolitical alignment become primary variables. Debt sustainability must be assessed under scenarios of prolonged cost pressure rather than temporary spikes. Asset allocation shifts toward resilience over optimization. Liquidity matters, but physical constraints matter more. This chapter of the story reveals a central truth. Inflation today is not a transient deviation from equilibrium. It is a signal of structural tension between an economy built on cheap energy and a reality where that condition no longer holds. Debt magnifies this tension by reducing flexibility and amplifying policy trade-offs. The system continues to function, but under increasing strain, absorbing shocks by sacrificing growth, stability, and cohesion. This is only the first half of the mechanism. The full impact becomes clear when these pressures converge with the limits of policy credibility and the diminishing effectiveness of traditional stabilization tools. The second half of this mechanism unfolds when policy credibility begins to erode. Inflation, driven by energy and reinforced by debt, does not simply challenge economic performance, it challenges belief. Modern macroeconomic systems rely as much on expectations as on instruments. When households, businesses, and investors believe inflation will be contained, behavior adjusts in stabilizing ways. When that belief weakens, the system becomes reflexive, amplifying stress instead of absorbing. Central banks find themselves at the center of this credibility test. Their mandate assumes a degree of control over price dynamics through interest rates, liquidity conditions, and signaling. That assumption held when inflation was primarily demand-driven and energy was stable. In the current regime, central banks confront a dilemma. If they tighten aggressively to demonstrate resolve, they risk deepening recession, destabilizing debt markets, and triggering financial accidents. If they ease prematurely to protect growth, they risk validating inflation expectations and entrenching cost pressures. Neither path restores the previous equilibrium. Both involve visible trade-offs. As rates rise, debt servicing costs become a binding constraint. Governments that expanded fiscal capacity during years of cheap financing face a narrowing corridor. Interest expenditures crowd out discretionary spending. Fiscal stimulus becomes politically harder and financially riskier. Markets begin to price sovereign risk not as an abstract concept, but as a function of inflation persistence and energy exposure. Yield differentials widen. Capital flows become selective. Financial fragmentation increases. Households experience this shift directly. Mortgage rates rise faster than wages. Rent inflation remains elevated due to construction costs and financing constraints. Energy bills fluctuate unpredictably. Even when headline inflation moderates, the cost of living feels permanently higher. This perception matters. It shapes consumption decisions, savings behavior, and political attitudes. Consumers become cautious, reducing discretionary spending. Businesses interpret this caution as weak demand, reinforcing investment pullbacks. The economy slows, but without the relief typically associated with disinflation. Corporate balance sheets reflect the strain. Input costs remain volatile. Financing costs rise. Pricing power varies by sector. Firms with exposure to essential goods can pass on costs. Others cannot. Margins compress unevenly. Capital expenditure plans are delayed or cancelled. Share buybacks replace productive investment as a defensive strategy. This preserves short-term equity performance, but undermines long-term capacity. The economy becomes less dynamic, more financialized, and more brittle. Financial markets internalize this regime shift slowly. Initial responses treat energy-driven inflation as transitory. Subsequent cycles reveal persistence. Volatility becomes a feature rather than an anomaly. Risk premiums rise across asset classes. Correlations that once provided diversification break down as energy costs affect everything simultaneously. Bonds fail to hedge equities reliably. Real assets provide partial protection but carry political and regulatory risk. Portfolio construction becomes an exercise in damage control rather than optimization. Internationally, the system fractures along energy lines. Countries with domestic energy resources gain strategic autonomy. Import-dependent economies face recurring trade-offs between inflation control and growth support. Currency depreciation offers temporary relief, but raises import prices. Capital controls and intervention become more common. Global coordination weakens as national priorities dominate. The idea of a synchronized global response to inflation fades, replaced by patchwork solutions. Energy exporters adapt strategically. Revenue management becomes central to fiscal planning. Supply decisions reflect long-term considerations rather than short-term market signals. Coordination among major producers reinforces price stability at levels that support fiscal break-evens. From a purely economic perspective, this behavior is rational. It smooths revenue and reduces volatility for producers. From the perspective of the global system, it locks in a higher cost baseline that importers must absorb. The interaction between energy inflation and debt also reshapes political incentives. Subsidies and controls become tools for social stability rather than economic efficiency. Governments intervene in pricing, markets, and supply chains to manage public reaction. These interventions distort signals and delay adjustment. Over time, they accumulate fiscal cost and reduce transparency. Markets struggle to distinguish between temporary measures and structural change. Uncertainty rises. At the same time, the energy transition complicates the policy landscape. Authorities attempt to pursue decarbonization while managing inflation and debt. These objectives often conflict in the short to medium term. Transition investments raise near-term costs and increase demand for energy and materials. Monetary tightening raises the cost of financing these investments. Fiscal constraints limit support. Policy coherence suffers. Credibility erodes not because goals are wrong, but because sequencing is flawed. This erosion has consequences beyond economics. Trust in institutions declines when promised outcomes fail to materialize. Inflation targeting appears less effective. Forward guidance loses influence. Political polarization intensifies as different groups experience costs unevenly. Energy policy becomes a proxy for broader dissatisfaction. Elections hinge on prices rather than growth. Long-term planning yields to short-term crisis management. From a structural perspective, this is the culmination of a long process. An economy built on cheap, stable energy, expanded debt, and complexity under the assumption that inputs would remain manageable. When that assumption broke, the system did not collapse. It adapted by stretching buffers, reallocating costs, and redefining norms. Inflation became tolerated at higher levels. Growth expectations were revised downward. Volatility became normalized. This adaptation preserved continuity, but at a price. The price is diminished flexibility. Policy tools lose precision. Trade-offs sharpen. Errors become costlier. The margin for miscalculation narrows. In such an environment, shocks that would once have been absorbed now propagate widely. Energy disruptions, geopolitical events, or financial stress reverberate through a system already under strain. This is not the end of the story, but it is a turning point. Energy, inflation, and debt have converged into a single pressure point that shapes outcomes across markets and societies. Understanding this convergence is essential because what comes next is not another cycle, but a structural adjustment that will redefine growth, risk, and power in the global economy. The final risk in this system does not come from sudden collapse. It comes from misalignment. The most dangerous moment for any complex economy is not when demand disappears or when supply vanishes overnight, but when long-term structures drift out of sync with short-term expectations. This is where the global energy system now stands. Investment, policy, and market behavior are moving in different directions, creating a widening gap that cannot be closed quickly or cheaply. At the center of this gap is supply. Oil production has not peaked in absolute terms, but it has plateaued in flexibility. The world can still produce large volumes, yet its ability to respond rapidly to shocks has deteriorated. Spare capacity is thinned. Development timelines have lengthened. Capital discipline has replaced expansion as the dominant industry logic. Producers no longer invest as if demand growth is guaranteed, and consumers still consume as if supply will always adjust. This asymmetry is the fault line. Investment data tells this story clearly. Upstream capital expenditure remains below levels required to offset natural decline rates over the long term. Mature fields decline every year, requiring continuous reinvestment just to maintain output. When investment falls short, the system draws down its future supply invisibly. Prices may remain stable for a time, but underlying resilience erodes. By the time scarcity becomes visible, it is already embedded. This underinvestment is not accidental. It is rational behavior in a policy environment that signals eventual demand destruction while still relying on current production. Energy companies face regulatory uncertainty, social pressure, and shareholder demands for returns rather than volume growth. Long-cycle projects with multi-decade horizons become unattractive when policy frameworks change within electoral cycles. As a result, supply growth shifts toward shorter cycle sources that cannot fully replace the scale or stability of conventional production. Demand, meanwhile, does not follow policy timelines. Industrial activity, logistics, agriculture, and defense remain oil-dependent. Emerging economies continue to grow energy consumption as incomes rise and infrastructure expands. Even efficiency gains in electrification reduce intensity rather than absolute use. The world consumes oil not because it prefers to, but because alternatives at scale do not yet exist. This creates a persistent demand floor that policy rhetoric often ignores. The most dangerous scenario emerges when this demand floor meets a constrained supply ceiling. Prices rise, not explosively at first, but persistently. Volatility increases. Governments intervene to cap prices or subsidize consumption. Strategic reserves are released, buying time but not creating new capacity. Each intervention reduces future buffers. The system becomes more brittle with every attempt to smooth it. Geopolitical dynamics amplify this brittleness. Energy exporters adjust strategies to preserve long-term fiscal stability. Production decisions reflect budgetary break-evens, demographic pressures, and strategic goals, rather than short-term market share. Coordination among producers, including those associated with OPEC, reinforces this approach. Supply management becomes a tool for stability from the producer perspective, even as it constrains flexibility for consumers. Import-dependent economies respond defensively. Energy security becomes a priority over efficiency. Long-term contracts replace spot exposure. Domestic production is encouraged where possible, even at higher cost. Trade relationships are reshaped around reliability rather than price. These adjustments reduce vulnerability but raise baseline costs. Inflation becomes embedded not as a spike but as a feature. Financial markets initially underestimate this shift. Price signals are interpreted as cyclical rather than structural. Each pullback is treated as confirmation that the system will revert to prior norms. This misreading delays adjustment in portfolios, policy, and planning. When the realization arrives, it does so unevenly, creating abrupt repricing rather than smooth transition. The feedback into the real economy is slow but cumulative. Higher energy costs reduce discretionary spending. Businesses defer expansion. Governments face rising fiscal pressure. Growth trends downward, not through recession alone, but through a persistent loss of momentum. Productivity gains fail to offset costs. Living standards stagnate even as output grows nominally. This divergence fuels social tension and political volatility. The critical risk is timing. Energy systems adjust over decades. Financial systems adjust over quarters. Policy systems adjust over election cycles. When these clocks fall out of sync, the adjustment burden falls on households and markets. Errors compound. Temporary measures become permanent. Expectations shift downward. What was once unthinkable becomes normalized. From an investor's perspective, this is not a prediction of collapse. It is a warning about regime change. The old playbook assumed that supply would respond to price, that policy could stabilize cycles, and that energy was a secondary variable. None of those assumptions hold fully anymore. Returns become harder to generate, risk becomes harder to hedge, strategy replaces optimism as the primary advantage. The most dangerous moment is therefore not in the future. It is the present transition phase, where the system still behaves as if buffers exist, while those buffers are quietly shrinking. When the next shock arrives, whether geopolitical, climatic, or financial, the response space will be narrower than expected. That is how structural crises unfold. Not through surprise, but through delayed recognition. This is only the first half of the final picture. The consequences of this misalignment extend beyond markets into the architecture of power, growth, and global order itself. The second half of this picture unfolds when misalignment hardens into structure. At that point, adjustment is no longer a choice. It becomes a constraint imposed by reality. The global economy does not suddenly break, but it begins to reorganize around limits it can no longer ignore. Growth slows not because of a single shock, but because the system exhausts its ability to borrow time. Energy constraints force prioritization. Not every sector can be protected. Not every price can be subsidized. Governments are compelled to decide which activities are strategic and which are expendable. Industrial policy returns, not as ideology, but as necessity. Energy-intensive industries consolidate or relocate. Marginal producers exit. Supply chains shorten, sacrificing efficiency for reliability. The global economy becomes less optimized and more fragmented. This fragmentation reshapes trade. Comparative advantage shifts from labor cost to energy access. Countries with reliable domestic energy gain leverage, even if their production costs are higher. Import-dependent economies face chronic external pressure. Trade deficits widen. Currency stability becomes harder to maintain without capital inflows. Financial openness becomes conditional rather than assumed. The era of frictionless globalization gives way to a world of guarded interdependence. Capital flows respond accordingly. Investors seek jurisdictions with predictable energy policy, stable fiscal frameworks, and manageable inflation risk. Yield alone becomes insufficient. Stability commands a premium. Emerging markets without energy security face higher risk premiums regardless of growth potential. Advanced economies with high debt and energy exposure lose their historical advantage. The hierarchy of markets shifts quietly but decisively. Energy producers consolidate power in this environment, not through dominance, but through indispensability. The ability to deliver reliable supply becomes a strategic asset. Coordination among producers, including those operating through OPEC, evolves further toward managing long-term decline rather than short-term cycles. Production policy reflects an understanding that remaining reserves must finance future stability, not maximize near-term volume. This reinforces a higher floor under energy prices, anchoring inflation expectations at levels above historical norms. Inflation itself changes character. It becomes less volatile but more persistent. Sharp spikes give way to chronic elevation. Policymakers adapt by redefining targets, implicitly if not explicitly. Tolerance bands widen. Communication shifts from promises of normalization to language of resilience and balance. This recalibration preserves institutional credibility at the cost of admitting that the previous regime has ended. Debt adjusts in parallel. High leverage becomes more expensive to carry. Refinancing cycles tighten. Fiscal choices become starker. Governments prioritize debt sustainability over expansion. Public investment focuses on maintenance and security rather than growth acceleration. Private leverage declines slowly through the leveraging and inflation erosion rather than abrupt defaults. The system absorbs the adjustment over time, but growth potential diminishes. Households internalize this shift intuitively. Expectations recalibrate. Consumption becomes cautious. Savings rates rise not out of optimism, but out of uncertainty. Asset ownership becomes more polarized as those with inflation-protected assets preserve wealth while others fall behind. Social mobility slows. Political discourse hardens around distribution rather than expansion. Technology does not reverse this trend quickly. Innovation continues, but its impact is incremental rather than transformative in the short to medium term. Efficiency gains are absorbed by higher input costs. Breakthroughs take time to scale. Energy remains the binding constraint. The promise of future solutions does little to alleviate present pressure. From a systemic perspective, this is how a new equilibrium forms, not through collapse, but through constraint. The economy continues to function, but within narrower bounds. Volatility remains elevated. Policy tools are blunter. Mistakes are costlier. Resilience replaces growth as the primary objective. For investors, this environment rewards realism. Understanding energy flows, fiscal limits, and political incentives becomes more important than forecasting cycles. Flexibility matters more than leverage. Liquidity is valuable, but so is exposure to real assets that retain utility under constraint. Returns are generated through positioning rather than momentum. The ultimate lesson of this chapter is not pessimism, it is clarity. The world is not running out of oil. It is running out of the conditions that made oil cheap, flexible, and invisible. That change alters everything built on top of it. The global economy is adjusting, slowly and unevenly, to a reality it postponed acknowledging for decades. This adjustment will define the coming era, not through dramatic endings, but through quieter reordering. Those who recognize the shift early will not avoid volatility, but they will understand its source. And in a constrained system, understanding is the rarest and most valuable asset of all. The next crisis will not look like the last one. It will not begin with panic. It will begin with denial. Oil will not disappear. Growth will not collapse overnight. Markets will keep moving until they cannot. The question is not whether the system will adjust. The question is who understands the adjustment before it becomes unavoidable. Because in a world defined by energy limits, debt pressure, and shrinking buffers, those who see the structure early do not escape volatility. They survive it. This was not a prediction. It was a map.